Hi, I'm Mark Hebner, President of Index Fund Advisors, and today I want to talk about a very important topic for investors. It's called safe withdrawal rate. It's one of the most common questions that investors have. Once I've saved for my retirement and I stop working and I am no longer relying on my human capital to generate income, I now have to move over and rely on my financial capital. Well, that begs the question, how much of my financial capital can I spend per year, for example, pick a time period, per month, per year, going forward so that during my retirement years, I will not run out of money. And in some people's eyes, they're thinking, I don't want to even touch my principal along the way. The sort of old school thinking is that you're going to only live off of the dividends during your retirement. Well, Merton Miller had a phrase for actually selling some of your investments to support your withdrawal rate, which he called homemade dividends. And that practice relies more on your total return of your investment, which is your capital gains plus your dividends. So I'd like to look at some examples of historical data as we have simulated it using our hypothetical back-tested performance data and look at some periods of time where the investments did the worst and then say, what if I withdrew some percentage of those investments over time? How would that impact my withdrawals and my ending value at my expected passing? So let's start off by assuming a couple of assumptions here, that you might be retiring at age 65, that your allocation is 65% stock indexes, because we're going to look at index data from the past, and 35% fixed income, and in this case, relatively safe fixed income investments. Safe meaning relatively short duration in the range of 2 to 3 years, and of high quality in the range of AA type of default risk, if you will, or quality of the bonds. So on our website, we have all of these allocations from really 0 to 100 allocation to stocks. And you can look at this data and slice and dice it and look at it in many different ways. But this is one of my favorite things to do with investors, is we go down to figure 2 on our portfolio pages, and you see that that has the title of the Simulated Passive Investor Experiences. So what does that mean? Well, we would simulate using back-tested performance of these indexes that we've created here at IFA, and you can go to our website. There's a button at the top that says IFA indexes, and you can look at the descriptions of those. We simulate that data over history, and we look at it on a monthly rolling basis. So that means we shift the beginning period of the period by 1 month, which then shifts the end of the period by 1 month. And so we can look at all of this monthly rolling data for various periods of time, 5 years, 10 years, 20 years, 25 years. And from that data, we can look for the single worst month that an investor could have started with over the last, let's say, 50 years. And that would be an indication of a good stress test, if you will, of your possible investment experience over your retirement. So if we go to portfolio 65, and let's just assume that you have 25 years of living in your retirement, that you want your financial capital to support you. And so let's come down in column A to 25 years, and you can see here that is 300 months. And if we look at our 50-year data and we look at how many of those 300-month long periods that we have, they're 25 years apiece, right? You can see here in column C that we currently have 306 of those 25-year periods to look at. And what we show you in this table, which is particularly useful, is what was the lowest rolling period return if you were in a portfolio 65. Now, to add one more element to this, to make it more realistic, I'm going to put this portfolio on a glide path. So now we can look at this data for 25 years. Click here, we see that the examples change above, where for each year you're invested, we reduce your exposure to stock indexes by 1%. So you might start here with a portfolio of 65, 12 months later you're in a 64, and 25 years later you're going to go from a 65 down to 40. And so as you age, your portfolio becomes a little safer, which reduces the chances that you will become nervous or scared during highly volatile periods and want to liquidate your investments and go to cash. That is the number one way to reduce the chances of you achieving these returns. That's not part of our passive investment experience investment strategy. By the way, in that strategy, we include an annual rebalancing of your portfolio. In the glide path case, we're actually rebalancing to the lower risk, right? And that's part of the strategy. So you can see when we do that at 25 years, the lowest return for that period was 5.97%. Let's call it 6%. And if you look here just to the left in column G, you will see that that occurred starting October 1995 and ending in September of 2020. So that was the least luckiest time for investors to invest, starting October 1995 and basically liquidating their portfolio at the end of that period, which is September 20. Now you might notice when you put your mouse on that date, there's a little pop-up that looks like a calculator, okay? That's going to take us over to the IFA index calculator, where then we can enter some more data and look at withdrawal rates and withdrawals and to see how that might support us in our retirement. So what we've done here is now carried over the settings from the portfolio page, which means it was portfolio 65 on a glide path. We also inputted those dates, which were the lowest return out of the 306, I think it was, periods that were 25 years long. And that was the October 1st, 1995 to September 2020, as you see here. And so now the only thing we need to enter is how many dollars are we starting with in our portfolio. And let's just put in there for sake of calculation here and testing that you're starting in your retirement with $1.5 million. And also, we can now choose here a withdrawal unit. And in this case, I'm going to put percentage of the portfolio. So I like to think of your withdrawals as a percentage of the balance of the account at the beginning of each year. So after we've had a bad year in the market, you need to tighten your belt a little bit, spend a little bit less, and after a good year, you get a little bit more. And by looking at these results, we'll get to see whether you think that if you had those withdrawals in the past, it would have supported your choices of lifestyle. So let's change this here to 6% withdrawal. You can also see that we've adjusted for management fees here, for the IFA management fee, which means that the longer you're invested, that $1.5 million grows, and the fees would adjust a little bit. But in this case, because you're going to withdraw 6%, it stays pretty much the same at the $1.5 million. But that is still a little bit less than our maximum fee because of our volume discounting. So here we can see over the 25 years, after you've withdrawn 6% per year from the portfolio, your annualized return is actually a negative 0.04%. let's call it a break even, and your starting value of $1,500,000 ends up being $1,483,000. Now, we're not considering inflation in these numbers, so obviously that's going to be a different from an inflation perspective. But let's look at how much we were able to withdraw from the portfolio. So the first year, which happens to end in September 30 of 1996, on that $1.5 million, at 6%, you were able to withdraw $92,000. And as you see here, that remains very steady throughout your entire period of the 25 years. Now, usually your spending in your retirement is sort of front-loaded in the early years because of desires to travel and maybe eat out more. And as you get older, assuming you've got insurance in place, your healthcare costs end up being one of your largest costs, but if the insurance is properly in place, that shouldn't be too bad for you. Also, you have to consider these are pre-tax numbers. So this is a way for you to sort of test and stress test the withdrawal rates of a certain percentage over certain periods of time, starting with different portfolios and on a glide path or not. And I find it very useful to quickly go through this exercise with clients. Now, there are many alternatives to this and many ways to refine the withdrawals and the additions to your accounts throughout your retirement. So, for example, you're going to sell your house at some point in time, or you're going to buy a house later. You can add these events in some of our other tools and do something a little more refined. But I like this because it's a good place to sort of stress test, if you will, the worst case scenario that we've had over certain periods of time and see how that would have worked out for you. And I've found that a 6% withdrawal rate based on the balance of the accounts each year is a reasonable way for people to think about a safe withdrawal rate of their investments during their retirement. I hope that was helpful, and I look forward to seeing you next time.